analyzed 1,000 scalping trades to find out why traders keep losing. And the biggest surprise was, most of the losses weren't due to strategy. They were due to a simple mistake that traders make over and over again. A little less than 1,000 trades that were back-tested. One pattern, one variable, and when I isolated it, the win rate went from 51% to 71%. It wasn't the strategy that was the problem, it was the trader. In this video, I'll show you the exact mistake, real chart examples, and how to avoid it. For this analysis, I looked at 1,000 Forex scalping trades. I focused on the things that actually determine the outcome of a trade: the timing of entry, the market structure, where to place a stop loss, the risk-to-reward ratio, and the trader's behavior after entry. The goal was simple: find the common patterns behind losing trades. Not one or two examples, but hundreds of repeated mistakes. And one mistake was much more common than any other. So let's move on to the first mistake I saw among many losing trades. Late entry. Number 1, entering after the move. Let's look at an example from the chart. Here the market has started to move up. Several strong green candles have formed in a row, and the move looks very clear. At this point, many traders have a common thought: if I don't enter now, I'm going to miss this move. So they enter a long trade. But that's exactly the problem. They enter when a large part of the move has already happened. Professional traders are usually in a position to enter before these big candles form. But emotional traders decide to enter when they see the move. That is, instead of waiting for the right opportunity, they follow the price. What does the market do now? After a strong move, the price usually needs a short correction. Then it starts to pull back. And the same trade that was supposed to be profitable quickly turns into a loss. Here is another mistake that most traders make. Instead of asking, was my entry point correct? They say, this strategy is broken. But the truth is that the problem was not the strategy. The problem was the entry timing. In scalping, the timing of entry is much more important than the number of signals. A professional scalper does not try to follow every big move. He waits for the price to return to a reasonable area where he can control his risk and have a better risk-reward ratio. Because in the market, there is a simple rule: you do not want to be the last to enter a move. You want to be ready before the move starts. And this is one of the biggest differences between an emotional trader and a professional trader. Mistake number 2, trading against market structure. Now let's move on to the second biggest mistake I've seen in scalping: trading against market structure. This is a mistake that even experienced traders make from time to time. Let's look at an example on a chart. Let's say the market is in an uptrend. The price is making higher highs and higher lows. This means that the buyers are in control of the market. But suddenly a strong red candlestick forms. This is where many traders think, well, the market is about to turn around. It's time to sell. And they quickly enter a sell trade. But here's the problem. A reversal candlestick doesn't always mean a change in trend. Sometimes it's just a short correction within the main trend. After the sell entry, the price resumes its upward movement and the trade is in loss. Here is an important question. Did the market really turn around? Or were we just trying to guess a top or a bottom? This is one of the biggest differences between professional and novice traders. A professional trader first examines the market structure. He asks, are the buyers or the sellers in control now? Then he looks for an entry point. But a novice trader usually just looks for a small signal to enter: a big candle, a small breakout, or a quick price move. In scalping, we must always remember the market does not have to move according to what we think. If the main trend is up, selling just because of a small correction can be high risk. And if the trend is down, buying just because of a short pullback can be a trap. Before every trade, ask yourself, am I going with the flow, or am I trying to anticipate the opposite of the market? Because most of the time, the market has no mercy on those who fight it. Mistake number 3, moving the stop loss. The third mistake was emotional management. The trader enters a trade. The stop loss is pre-planned. But when the price gets close to the stop loss, they move it. They say, I'll give it a little more room. This small decision creates a big problem. A controlled loss becomes a big loss. Professional traders don't avoid losing trades. They control them. A stop loss is not there to hurt you. It's there to protect your account. So now that we've seen the 2 biggest mistakes scalpers make, Let's see how we can reduce the likelihood of making these mistakes with a simple tool. Here we'll use the EMA 21. The EMA 21 is not supposed to predict the future of the market. Its main function is to help us see the short-term direction of the market better. Rule 1. When the price is above the 21 EMA, we look for better buys. Suppose the market is in an uptrend. The price is moving above the 21 EMA. Every time the price returns to the 21 EMA, instead of entering at the ceiling, we wait for a reaction from this area. This makes a big difference. We are no longer chasing the price. We wait for the price to return to a reasonable point. This helps to reduce the first mistake, which is entering after the move. Now, the second rule, we do not take any trades against the 21 EMA. If the price is below the 21 EMA and the EMA is also sloping down, it means that there is more selling pressure. In this situation, taking a buy trade just because of a small green candle can be dangerous. Conversely, when the price is below the 21 EMA, we look for sell positions with the market trend. This simple rule helps us fight less with the underlying market structure. But here's an important point. The 21 EMA alone is not a complete trading system. We are not supposed to enter a trade every time the price reaches the EMA. We still need confirmation. For example, market structure, support and resistance area, confirmation candle risk management. The 21 EMA only acts as a filter. It helps us know, are we in the right direction of the market right now? Or are we trying to go against the flow? In the end, one of the biggest lessons we can learn from examining thousands of trades is this. Successful traders are not always looking for more signals. They are looking for better decisions. Sometimes a simple filter like the 21 EMA can keep you away from a lot of bad trades. Now let's look at a sell example. Here the market is below the 21 EMA. The EMA slope is also bearish, so we don't buy. We wait for the 21 EMA to return. The price returns to the EMA, but fails to consolidate. Entry, stop loss is placed above the last high. Stop loss price and planning target. Take profit, target price. This time it moves based on the analysis and closes with profit. Result, plus 2.5 R. After reviewing hundreds of cases, what stood out the most was, they weren't always because of a specific indicator. They were the result of better decisions. Patience to enter. Going with the market structure and controlling risk. After analyzing 1,000 scalping trades, I learned one thing. Winning traders don't find more opportunities. They avoid bad decisions. If you want me to analyze another 5,000 Forex scalping trades and find hidden patterns, subscribe to my channel and let me know in the comments.